talk about compound interest, is equity the only way? When we talk about compound interest, is equity the only way?
Okay, there is a technical difference here that I will try and address. Then I will try and answer your actual question. See, we are all aware, I think 6th standard or 7th standard, correct me if I'm wrong. These days, children, the concepts are introduced much earlier, the compound interest, etc. That's when they learn this formula of compound interest, etc. But compound interest, its interest applies to debt or fixed income investments. Compounding or compounded annual growth rate is what applies for equities. But yes, compounding is very, very important. But when you invest in debt also, your money compounds, no doubt about that. We are talking at lower rate of compounding versus higher rate of compounding. Let me try and showcase that. I think this was let me try and use the pencil here. The compound interest is like this: 100 rupees into 1 plus r to the power n. So here there are 3 components. FV, future value, your retirement. This is your retirement corpus. This is what you invest. This is what you earn. This is what you wait for. N is the number of years. The earlier it is, so better. There are 3 components. So how much you invest is more money you invest, more future value. But more number of years, yes, that also means more future value. You don't have much choice here. Starting early. I mean, if you are 40-year-old, you are 40-year-old. I am a 40-year-old person. If you are 30-year-old, then you are a 30-year-old. So, but yes, start early investing. So this determines your compounding. Invest as much as possible. Do you have a say in this? Yes. But if I say don't spend, invest, I mean, I'll be preaching so many things and I'll be interfering in your life. Then you will say, oh, I know where to spend my money. You will say that, don't buy a car, invest in HDFC FlexiCap. Can I say that? It's none of my business? That's your this thing, or your investment expert has to tell you how much to invest. That's not the job that the AMC people are doing. But what's the most important place where people go wrong is this. I've seen people go wrong in this. My friend tells, oh, I should have started financial planning 10 years earlier. People say that. That's very unfortunate. I realize the importance of financial planning only at 35. I have lesser time. But still you have a lot of time. So N. Oh, I have spent too much money. I won. Many people say, I bought this phone for 80,000, man. I shouldn't have done that. I'm feeling very guilty in the heat of the moment. I bought that. So instead, had you invested more compounding. So, but people don't take too much this thing into this R part. R is your asset allocation and product selection. How much money is into equities? Let me give you a thumb rule. Anything divided by 7.2 is your time taken to double your money. The rule of 72, we call it. For instance, if the rate of return is 7.2 in an investment, it takes 10 years to double your money. If the rate of return is 3.6, it takes 20 years to double your money. If the rate of return is 14.4, it takes only 5 years to double your money. It's like the rule of 7.2 or rule of 72. So that is from this formula only. So higher the compounding rate, higher is the end corpus. And that's what we have seen here. We have kept the initial investment as 100. We have kept the years as 25. We have kept the returns as 5 versus 10. I mean, I didn't tell what is 5, what is 10. 5 is debt and 10 is equity. That's the difference. I should have told that. In fact, this question reminds me to tell that. I mean, I am not giving you an expected return. It's not, we can't do that. This is just base illustration, just for illustration. If you invest in fixed income, you are likely to get returns like this. If you are investing in, I don't know, maybe this, that historically the returns have been much higher. If you see HDFC Flexi Cap Fund, since inception, the compounding rate of return has been 18% per annum. In Balanced Advantage Fund, it's 19% per annum. So things have been great in the past, but in future we have to moderate our expectation, because India may not be, I don't know, India may be a fast growing country, but the nominal GDP growth could be lower. You may be entering at a high valuation levels. Markets may have been cheaper 20 years back. So many differences are there which should make you reduce your power of compounding. But yeah, if you want to increase your overall equity asset allocation returns, overall portfolio returns, for the compounding, you should have equities. Do not shy away from equities.